Welcome to our eighth session of This Week in the Market. I'm Terry Horan, your narrator, and with me is Managing Director of HCA Horan Capital Advisors, David Templeton, Matt Antonucci, CFA at Horan Capital Advisors, and his birthday yesterday, so warm birthday wishes.
Thank you.
Greg Hornschmeyer is with us, and Michael Napier is on the line. So to give you a little perspective of where we've come from and where we've been, on February 28th, the S&P 500 hit its high in history, 3,386. Less than a month later, it was down 34%, 2237. And less than 6 weeks later, it's up 30%. So keep your seatbelts on. This has been somewhat of a wild ride, and certainly, again, speaks well to staying invested, we think. Horan fundamental focus on this week is be a fanatic about response time, and hopefully we're being a fanatic about our responses to you. It simply acknowledges we've got the question and we're on it. We want to keep those involved continuously updating the status of outstanding issues. Rapid response is one of the easiest and best ways to stand out in the crowd. Our theme today is interesting. Stock market returns in a presidential election year, an historical view. We'll talk about the presidential cycle in the market, the economy with states reopening, and then we'll invite Michael Napier and Greg Hornschmeyer in for some questions that we have. As always, you can get a reprint of this webinar on our website at Horan. So David, Matt, why don't you get us started?
Thanks, Terry. So if we move to slide 3 there, we want to take a look at the historical market behavior around elections and their outcomes. And we're showing you a great chart from Fidelity that looks at this data going all the way back to 1789. So we're looking at a lot of data and a number of things to point out. The first thing is the bars on the left-hand side in the red, which is called the presidential cycle for markets. And this is the average returns of the market during each year of a president's term. And it's really interesting to see that as the term goes on, the average market return tends to be higher each year, the strongest year being in the 4th year of the term. And we've clearly yet to see these types of gains, 9.1% gain on average, but we still have a lot of time to go for the rest of 2020. But we oftentimes get the questions during an election year, what would happen to the market when this group or this party gets into the White House or Congress or whatever it may be. And on the right-hand side, in the blue bars, we're showing you historically what's happened, the market returns for a number of different election outcomes. You can see the average for all elections on the left, and then different scenarios going across the bottom. A Republican president being elected, Democratic president, different sweeps with the Senate and the House, and then divided Congress with a Republican president and divided Congress with the Democratic president on the far right. And the dark blue bar for each outcome on the left shows the forward 2-year return of the market. And the light blue bar for the right of every outcome is the forward 4-year returns. And it's really interesting to see the near term or the dark blue. There's definitely some market variations with each election outcome. But importantly, as you look across the light blue bars, so you can see the 4-year forward returns, the longer term results are all very similar across different election outcomes. For example, one of the questions we get oftentimes is what happens if a Republican gets in or a Democratic president gets in, and you see the difference between the near term results there. The dark blue, typically, historically, the market's return on over a 2-year period higher versus a Democratic president, but 4-year returns, longer term, results are virtually the same. So it's natural for people to point out to the near-term results and say, aha, see, my party is in there, and it's good for the market when that happens, and the other's not, but we would definitely caution against that. It's much bigger than just an election outcome. There's different things happening around the world and different policies being proposed, different agendas, and it's more about, over the long-term performance, market fundamentals and who is in power from a political standpoint. with that, I'll turn it back.
Matthew, what you're saying then, therefore, is on a 4-year cycle, the politics really don't matter much. What's fundamentally matters is market returns, business returns, economic strength or weakness.
That is what we're saying, and it's important to point out, that's for the overall market. There can obviously be some nuances when it comes to different policies that an administration might be proposing from an industry standpoint or a sector standpoint. There can absolutely be, some big shifts in the way that different industries do business, but from an overall standpoint, it really comes back to the fundamentals, no matter who's in power.
Business fundamentals. Well, thank you. That's great. David, are you going to talk about what it means for the states to be opening up?
Right. So getting to the fundamental part of it, we are now seeing that on this slide, 25 states are reopening in some fashion. Now, California announced yesterday that they're going to start too, so that would be 26 states. But as noted in the bullet point on the slide, the shutdown is coming to an end. 22 states meet the reopening criteria, 14 days of declining new cases, and 29 states meet criteria of a 14-day downward trajectory of positive test result percentages. The takeaway is we are beginning to see a pickup in economic activity. And on the next slide, this shows the purple line. The purple line references Georgia, and it's relating to consumer spending on barber and beauty shops. The one obvious area experiencing increases is in this area. A lot of people need a haircut. The purple line there on the chart pertains to Georgia. As I said, the line represents the percent of spending compared to the first week of January, and it is a rolling 7-day average. Clearly, spending in this area is rising in a V-shaped manner, and we talked about different types of recoveries a few weeks ago. Now, we don't think all economic areas or segments are likely to see this type of recovery, but some are, and we have made portfolio changes to take advantage of some of this type of activity. If you look on the next slide.
Well, before you go there, I want to interject that I have friends and relatives and a sister in Georgia, and she has gone out and gotten her hair colored, so she's helping with this business, I can tell you that.
She is a part of that statistic.
She's part of that V-shaped recovery.
Exactly. We thank her for that.
Yeah.
On this next slide, this is for consumer spending broadly in the U.S., and it's comparing it to 2019. And where you see that red arrow, we are seeing a pickup in consumer spending, and that is important. As these states open up, we are seeing consumers go out and spend some money. And because historically, the consumers account for 70% of economic activity, the fact that these states are opening up we are going to start seeing a pickup. And some of that, the stock market's reflecting some of these positive data points.
David, there was an article this week that would indicate that seniors, those over 65 and those that might still be impacted by this shutdown, represent 20% of that consumer spend. So does that have an impact?
I mean, it does, and I haven't thought about that specifically, but we are seeing areas where, like in the restaurant space, restaurants are opening up. We own Cisco Foods for clients. Well, these restaurants are going to have to restock. That would be kind of a stock that might react favorably, like in a V shape, like the beauty spend. Tyson Foods is another one that we know where we lost it.
I can hear now.
Okay,
Not sure where we dropped off there. Do you know,
where did we
Mike?
drop off, Michael?
When we were talking about with David on the seniors being a big part of the 20% pullback on spending.
So then I think we went to, some industries will have a V shape, some industries will have a U shape, some industries will have a L shape.
Yep.
And
And we're factoring that into our
Election.
decision-making process.
yeah. So as you take this information and think about it, David, for the average investor, for our clients, do we stay in cash? Do we try to bottom fish, or do we stay invested? What do you think?
Matt, do you want to take that?
Yeah, I mean, I think it's a combination, you know, that we're cognizant of the risks in the market right now. And, you know, if you're sitting on a bunch of cash, I think it's important to note that we've had a really big rally here. And, you know, you might have missed the rally, but, you know, we're more advocates for dollar cost averaging into the market and being patient with your money. So when the market presents opportunities again, and as we know, the market does present opportunities, the average pullback for any given year is about 14%, and we've experienced more than that this year. But there is the possibility that we get another opportunity and start to buy some things when stocks go on sale. So it's not an all or nothing type thinking where, you know, I need to be in or out of the market. I think you take a combination of those approaches and just be patient with your cash.
And with the other money, probably stay invested, especially younger.
Absolutely, especially if you're younger. You know, you have a long time for this money to work for you, and just keep your perspective on that. You know, when stocks go on sale, it's an opportunity for those who are accumulating and looking to compound their wealth. But otherwise, stay invested, we would say.
Yeah. Greg, we've been talking about the market and stocks, but really these same principles apply to variable life and to IUL, does it not? Maybe you can explain those two terms and what they mean for investors.
Sure. Thanks, Terry. Yes, what Terry's referring to, there's two life insurance policies that we deal with a lot with our clientele. One is a variable universal life, and one's an indexed universal life. The biggest difference being the variable life works a lot like your 401k. The underlying investments inside your life insurance policy are tied to a grouping of mutual funds that particular insurance company provides. So these need to be actively managed. With our clients, we use David and Matt and their team to help us keep track of these, because it's like your 401k, you don't want to fall asleep at the switch and follow these underlying investments, because as the market goes up, obviously your cash value returns can go up. But as the market goes down, if we're not actively managing these and lose track of them, obviously there could be some problems long term. Index Universal Life is a newer product. It's been around probably the last 10 to 15 years, picked up some popularity. Really with the Index Universal Life, the big difference is the returns on your policy are tied to a particular index. In most cases, the Standard & Poor's. The nice thing about these policies is there's an upside potential that you can share in with the index. However, the insurance company typically puts a cap on the gain of what that might be. But the biggest pro with this is in a down market like we're in now, a lot of these insurance companies will give a 1 or 2% floor or guarantee, if you will. So as the market goes down, you are protected from some of that market loss. So really, I always look at these products as really having bumper rails on it. The Index Universal Life, you can share in the upside potential, but you're protected on the downside.
Yeah. Basically, with the IUL, you're buying a hedge.
Correct.
Against the downside.
That's correct.
And the cost of the hedge is somewhat priced out on the top.
That's true. That's true.
Yeah. Yeah, well, thanks, but it just illustrates that you have to be careful with these products in the same fashion.
Absolutely, just like you would in the market.
accumulate great wealth or go to sleep and you might lose.
That's right. They need to actively be managed.
Yeah. Thank you for that. Thank you, everyone. I think that wraps it up for the day. Our theme next week, beginning at 12 o'clock, will be Social Security. Michael, Matt, Greg, thanks so much, and David, we appreciate it, and see you next Friday at noon.